Hello, for everybody joining today's webinar. We will be getting started just momentarily. We still have a few people filing in. Thank you, and please stay on, and we will get started in just a moment.
Hi, what's going on, Sandra? How you doing? Good to see you. Great. How are you? Good. Good. Yeah, I know. Crazy. I know. So we'll see how it goes. So I'm gonna try to keep it short and sweet. I think this presentation has to do with like distribution as opposed to like what people maybe are here for, which is information on like investing in your 401k and stuff like that. So this is what? Yeah, so this is this it's really distributions. It's like specifics. Your 401k. Yeah.
But distribution.
For those joining us on the webinar, we will be starting in just a moment. Just have a few people filing in,
Yeah. So
and we'll be getting started in just a second. Thank you.
So we might have like a mismatch between like people's expectations. So I'm gonna just try to hit some key points, maybe enlighten some people, and then let people ask questions. Yeah, exactly. But then also let them ask questions. Yeah. Right. They came in with specific questions. Kind of team like that. Cool. Yeah.
Hello, everyone. My name is Anjali Nunn. I'm the sales assistant for the for the Cal Coast Financial Services. Welcome to California Coast Credit Union. Thank you so much for coming. And I'd like to introduce our speaker, Kyle Johnson. He is a financial advisor for California Coast Financial Services. Cal specializes in a wide range of services such as risk evaluation, portfolio analysis, retirement planning, and succession planning. He earned a Bachelor of Arts degree in Business and Economics with an emphasis in accounting. He is an accredited asset management specialist and currently holds his Series 766 and insurance registrations. Before I hand over the mic over to him, just a couple housekeeping items. The men's restroom is right outside here, and the ladies' restroom is behind a locked, secured area. And so if you need to use the restroom, come see me. I'll escort you over there. And I think that we'll hand it off.
Okay. Thanks, Anjali. Appreciate it. Yeah, no applause necessary. I promise. Thank you. Thanks for coming. I really appreciate it. So I know you're all probably here for a bunch of different reasons. And you may have some specific questions that you guys might want to ask me towards the end. Feel free to write them down and kind of save them towards the end. What we're going to be talking about today mainly is going to focus on kind of rollovers, what distributions look like, tax implications from rolling over or withdrawing from a plan, right? So you guys have all, who here has a 401k or an IRA or okay, perfect, 403b Roth, okay, right crowd. I'm in the right crowd, okay. So at a certain point, you're going to want to spend that money, right? And so this is what it's going to, what we're kind of going to be focusing on today. But a lot of our job is helping you grow, helping you increase, what you have, save what you have, pair your risk with what your goals are in retirement, right? We're going to be a little bit more focused and niche on the distribution portion of it for today. But if you have any questions on anything about your retirement plans, anything, we'll have plenty of time for questions afterwards, right? So right now we're going to talk about, I have it right here. So first thing that we're going to take a look at on the agenda is tax considerations, certain distribution methods, some certain points to consider, and the importance of a financial or tax professional. So needless to say, I am not a tax professional, so I'm going to get that out of the way right now. So here's my disclaimer: I'm not a tax professional. You have particular situations that apply specifically to you, and so I would recommend seeing a CPA. Now, we usually work with and partner with CPAs. Kind of our choosing, right? And so we have recommendations for CPAs for some of our clients, and we try to work closely with them to make sure that one hand knows what the other hand is doing as far as your financial health is concerned, right? So, so let's jump right into it. So tax rules encourage the use of retirement plans to save for retirement. What do you know? So distributions from traditional plans are taxed at ordinary income tax rates, right? So traditional plans are regular IRAs. Now, special rules apply to Roth IRAs and Roth type of accounts, right? But for traditional types of plans, every dollar that you have is going to add to your income in retirement, right? So let's just say you have Social Security, maybe a pension, anything like that. Anything that you would draw from this account is going to look like additional income for you. To qualify for a tax-free treatment within a Roth, the participant must be at least 59 and a half. There is also a 5-year rule with a Roth account. Has anybody heard of a 5-year rule before? Okay, perfect. So 5-year rule essentially says that you have to have an account open for 5 years or greater in order to be able to access any earnings that you have within that account. And there's also some additional rules that apply as far as your passing on to your beneficiaries, and we'll go over that in the future as well. But just know that there is a 5-year rule with a Roth account. So at the other end of the spectrum, retirement plans generally require that you start taking distributions no later than April 1st. And so I don't know if you guys are aware of this, but luckily due to the Secure Act, the 70 and a half that was used to be required for required minimum distributions has now been pushed to age 72. So you do not have to withdraw anything from your IRA until age 72, which is great. On the other end of the spectrum, they have done away with what we call the stretch IRA rule, and I can go over that in a second. But essentially, that limits any of your beneficiaries of your IRA to a 10-year holding period for that balance of the IRA. So let's talk a little bit about early withdrawals, right? Generally, early withdrawals are before age 59 and a half are subject to a 10% penalty. I think a lot of you guys know that, but want to make sure that I get it out there. Additionally, like I said, anything coming out of a traditional account will include a income tax for you. So there are certain exceptions, however, to early withdrawals, right? Death, obviously if you die, your beneficiaries aren't going to be taxed to early withdrawal penalty. But in a Roth account, earnings may still be subject to tax if they haven't hit that 5-year rule. So I'll explain in a second. Disability, if you're disabled, anybody who's disabled or has a child who's disabled may qualify for early withdrawals. Deductible medical expenses, qualified medical expenses work, leaving a job after age 55, and substantially equal payments. So this is the 72T rule, meaning that if you set up an annuity that has substantially equal payments, according to the tax guidelines, you may be able to take early withdrawals. There's certain other items as well. So if you have a first-time home purchase, you're allowed to withdraw $10,000 for a first-time home purchase. If you have certain college tuition and qualified college expenses, also will be an exception to the 10% penalty. So if you guys have any more questions about that a little bit later, I'd be more than happy to help answer those as well. But it's not just set in stone. So going back to the Roth IRA, I wanted to make sure that I kind of touched on a couple of things. So the 5-year rule, like I was saying before, if you have a Roth IRA and you've held it for less than 5 years and you pass, right, then what goes to your children, anything that you put into that Roth account is still going to be tax-free and penalty-free. However, if they withdraw all of it immediately, then any earnings could be subject to taxes for them, right? So I always encourage clients, if they have a Roth IRA, or are thinking about having a Roth IRA, to open it early and get it actually running and up and going, so you can hopefully avoid that 5-year rule in the future. Additionally, with a Roth IRA, a lot of people don't know this, but if you have a Roth IRA balance before 59.5, if you start to withdraw from that Roth IRA, you're allowed to take any money out of that tax and penalty free up to what you've contributed to it. So even if you're in your 30s or 40s, you can still take whatever you put into that because you've already been taxed on that money, right? We try to avoid it, right? So this is like a fire extinguisher, right? It's available if you need it, but we try not to use it too often if we don't need to, all right? So I'll move on to the next slide here. There's 2 common methods, so lump sum and a rollover, right? A lump sum distribution, this is you just taking the money, right? Taking the money and running. This is what we usually try to recommend people against. Taxes are going to be assessed on the entire amount right away, right? When you take a lump sum. So by law, if you take a lump sum, they're going to have to withhold 20% in taxes, no matter what. Any amount that's not covered by the 20% withholding is made up when you file your income taxes. And after age 59.5, the IRS, if it is before age 59.5, you're going to get the 10% penalty as well. This is where I scare you away from withdrawing early. So if you take a $25,000 distribution, they're going to withhold $5,000 for taxes. And there's also going to be a 10% penalty. And oh yeah, by the way, you have an additional tax obligation. So what you got out of that $25,000 is actually going to be closer to $16,250, right? So at the end of the day, the idea is to put away for retirement. They're specifically created for retirement savings, and so treating them as such is going to be a net benefit to you. So rollover. So let's talk about that. A little bit more attractive option, right? So moving retirement assets between plans, and it preserves the tax advantages of the assets. So there's 2 types of rollovers, right? There's a direct, which is a check made out to an institution, right? This is what we do most of the times, right? So a direct roller is when you take, when one of your custodians that you currently have writes a check to the new custodian and essentially sends it on over. So typically speaking, with most of our clients, this is what we usually will do. So this could be initiated on one or both ends. So let's just say you have a 401k. What we'll do is we'll go ahead and sit down with you, come up with a portfolio that's suitable for your risk tolerance and what your goals are in retirement. And then what we'll do, once we've kind of figured all that out, is we'll send a transfer of account paperwork with a statement attached over to your old 401k. They'll usually just send it right over and everything is moved over in kind. And we take it from there, right? So this is the easiest way to do it. There is an indirect way, however. So if you choose to do an indirect rollover, the check is made out to you and you're responsible for investing the assets in a retirement plan or an IRA within 60 days, right? So some of the issues that come up with that, it's not terrible, but if you do, just remember that they're going to withhold 20% of your taxes, right? So they're going to withhold 20% of the check no matter what, right? So the remaining 80% has to be rolled over, like I said, within 60 days to qualify for a retirement account. And finally, when you give the assets to a new plan or IRA or custodian, remember to re-include that additional 80% that might actually come out of your pocket, right? So you're going to have to roll over the additional 20%, so that doesn't look like another distribution, right? So you have to roll the entire balance, and so you might have to self-fund a portion of that since they withhold 20% for taxes, right? Sure. Yep. Good question. Good question. So the question was, we're trying to do an indirect rollover right now, right? And they're holding up the money from U.S. Bank. What's the process and what happens? So if you self-fund the amount that you're missing from that check, right? Essentially, what you really want to do with an indirect rollover is have a good CPA, right? Really crucial to have a good CPA when you do an indirect rollover to make sure that everything ties out, right? What you could do is essentially take whatever funds that you would have had and just replace it, right? So what you're going to be doing is you're going to show, hey, we have this check, we put it in here, right, for a rollover. We also have added these additional funds to supplement the rollover, right? And that's going to show. And then what's going to happen on the back end is they're going to send you a 1099 with the rollover and the withholding, right? And the government's going to owe you that money back, right? So, I mean, essentially, that's really what it boils down to. Yep. Exactly. So that an additional downside of doing this is it's kind of like an interest-free loan to the government, right? Just like any other taxes that you withhold from anything else, you're essentially just giving the government, here you go, here's some money for now, and you can pay me back later, right? I'd rather, for the most part, I'd rather force the government to take it from me than to give it and force them to give it back, right? Any other questions on that for now? Okay. So again, some points to consider is our required minimum distributions, some installment payments. There's certain special tax treatments for certain things, and then annuity payouts, and then talking to a financial professional, right? So, like I said, this year we're now going to have a new RMD age, which is going to be 72, which is great. So this year we're going to have a very unique situation where we don't have any new people signing up for RMDs. Should make our job easier for maybe a year, right, Sandra? So some plans may allow a delay in RMDs. So this is actually what a lot of people used to do. I always used to wonder, why are there so many Walmart greeters, right? So sometimes the Walmart greeters would actually, being older and successful, right? They're just hanging out there. Well, they would have qualified for a 401k, and they could roll their IRA into a 401k at Walmart. And if they're still working, then you don't actually have to take that withdrawal, right? So as long as they work enough days to be considered qualified for the 401k, they're in, right? Additional, also, guys, look at your plans, right? So if you have a 401k or an IRA with your employer, there's a lot of different rules. Some of them are more flexible than others. Some of them are more costly than others. Sometimes you can take loans against your IRA or against your 401k with your current provider or your employer. And so it's important to know, what the rules are within your 401k, right? So installment payments, this is pretty easy, right? Installment payments, when you look at it, these are pretty much annuities, right? So these help spread out the tax bite over time. Essentially, you set up a payment, you put in a lump sum, and it'll essentially spread out your tax payments over time. There's a lot of different options within the annuity space, right? If you're interested in that. So certain annuities could be suitable, and unlike just a regular, just taking money out of your 401k, it includes certain things like death benefits. It can include guaranteed income for life. It can include joint income, right? So let's just say you have a spouse, or if you have a pension, right? And your pension expires when you pass and you're older than your wife, right? Or husband, whatever it is, you're substantially older. Well, this might be worth looking into, because then you could have not only guaranteed income for your life, but guaranteed income for your wife's life as well, or your other spouse, right? Which is something we see pretty often. It may also provide additional income early, and like I said, provide maybe a death benefit that's the same value as what you put into it, right? So again, there's so many different options, and what's suitable for you might not be suitable for somebody else. So again, this is part of the considerations that we take when we're dealing with our clients, right? Additionally, sorry, is that, let's see here. Is anybody here born before 1936? Okay, pass. So again, we'll go ahead and pass the annuity payouts. Again, it's, very simple. So again, speaking of, of what we do, so some of the reasons why people roll over their 401ks, right? So we've kind of talked about what happens after you take a rollover, or when you start to take distributions. So some of the reasons to roll over your 401k includes a lot more options, right? Allows you to consolidate a lot of your other 401ks. And if you have a bunch of 401ks out there, by the way, you're going to be required with the RMDs, you have to take a distribution from all of them, right? So rolling them into one single place makes it a lot easier for you, and allows you to have a strategy that's cohesive, right? Rather than this one has this over here, this one has that over there. Additionally, for the most part, most 401ks are going to have about 6 or 7 options, right? They're going to have some target date funds. They're going to have a large cap option, a growth option, a bond fund, a world fund, a small cap, and then that's pretty much it, right? That's about as far as it goes. Does anybody here have a target date fund? Okay, yep. A lot of people, when you sign up for normal 401k, they put you in a target date fund. Does anybody know what's inside of those target date funds? Nice, good. A lot of people do not know what their target date fund is made out of is from an asset allocation standpoint. They don't know the investments in it, and they certainly don't know whether or not it's going to help them meet their goals, right? If you wanted to buy a share of Amazon, for instance, for the most part, in most 401ks, you're not going to be able to do that, right? So rolling over a 401k has a lot of benefits, and most importantly, it allows you to custom tailor your retirement and your income to whatever suits your needs, right? So I wanted to keep this as brief as possible because I know that probably a lot of people came in here with their own kind of questions regarding retirement, right? So whether it be in the 401k space, whether it has to do with distributions or whether it has to do with investments or the economy in general, I'm more than happy to field any questions that you guys might have. So if there are any questions, feel free.
Let me know. I'll run a mic over to you as well, so our webinar attendees can hear you.
Sure, go ahead.
So we've been told to diversify our investments to minimize risk.
Sure.
That would imply that you can control the vehicles that are being invested.
Mm-hmm.
So I assume once you're, let's say, retired, that you wouldn't want to necessarily invest in a target date mutual funds, that you can't necessarily control what that individual is investing in.
Yeah. So normally with a target date fund, it'll generally speaking starts as a more aggressive, and then it ends a little bit more conservative towards retirement, right? Generally speaking, it doesn't continue to get too much more conservative. Sometimes it ends up being too conservative, right? And it really depends on what you're looking to do in retirement, right? And so, for the most part, you might have, let's just say maybe you have $1 million, right? Yeah, or $2 million in it, right? Well, great, that's amazing, but you may not need the same risk exposure that you have inside that retirement, right? Especially if your expenses are $60,000 a year, right? So you may want to deleverage. If you, let's just say, don't have a ton in there. You know, with a lot of the health benefits. Actually, I just saw a study yesterday that if you've made it to retirement, the average age for a male is somewhere around 88, and it's about 92 for women, right? Once you've made it there. So that kind of takes out some of the people who are a little bit younger, right? And so have done some dumb things or whatever else, right? But if you made it there, there's a good chance that you're making it to 88. So a lot of people are getting a lot more, you know, really need to actually worry more about increasing risk in their portfolio than they do decreasing risk, just to make sure they make it through retirement, right? Additionally, you know, one issue that we really look at a lot is, you know, we will run into those clients that have $1 million in their IRA or their 401k, and you know, as a cash balance, they maybe have 20 grand, right? And maybe they have, you know, 10,000 in a Roth account, right? So for them, you know, generally speaking, what we'll usually do is we'll set up a strategy to maybe get them more into after-tax dollars, right? So let's just say they had an issue with their house, right? Let's just say you have, or you need to buy, you know, there's a medical expense, right? You have $50,000, but you're also making, you know, $60,000 between your pension and your Social Security. Well, now, and maybe let's just say you have you know, an income property, right? So now every dollar that you take out of that IRA is going to be taxed at whatever your maximum tax bracket is, right? Maybe it's 22%, right? So if you take out another $50,000, well, that not only are you going to be taxed now at that 22%, but now you also have the potential to go into the next tax bracket up, right? And so having a pool of two different pre-tax and post-tax really allows you to have a little bit more of a shell game with the IRS and have a lot more flexibility on how you spend that money, right? So maybe getting together at the end of the year and saying, okay, well, how much money did we make this year? Okay, well, maybe we can convert or do a backdoor Roth conversion to essentially transferring it from, you know, a pre-tax or a post-tax to, or a pre-tax to post-tax account will be really helpful, and will also allow you to manage how much taxes you're paying and make sure that it's manageable for you the next year, right? So now you can actually calculate what you're really going to be owing the government, and is it manageable, right? So I'd rather actually plan for that than be forced to take it out and then now have to pay this no matter what, right? And so having a continued strategy of, you know, that applies to that is really powerful as well, right? So I mean, that again, aside from just regular management, you know, we come up with a strategy that helps, you know, in a lot of different areas, right? Are there any questions? Yeah.
So if you have a retirement fund, 401k, whatever,
Sure.
and you're going to draw a portion of it into a Roth.
Yep.
All that you withdraw is counted as income tax.
Yep.
And once it's in the Roth, you're just going to accumulate whatever you're going to accumulate.
Mm-hmm.
But if you're drawing from that fund, good.
Yep.
Part of your expense at the end of the year, your Roth is going to be down to zero. Or close to it, potentially.
It could be, yeah.
Well, assuming you don't want to take a big enough chunk to bump you up to the next tax bracket.
Sure. Sure. Yeah. So the question.
I guess my question is, what's the advantage?
The advantage. So let's just say hypothetically, the advantage is, let's just say you have that income that you have, right? So let's just say you have a Social Security and you only need to take a certain amount out of, or you have a joint income, right? And you only need to take a certain amount out every year in order to cover just your basic expenses, right? Maybe you don't need to take out anything during a certain year in order to have certain expenses. Well, let's just say hypothetically, we're in the situation where you do need to take out money in order to kind of live off of and fund your life, which it is what it is. What you might want to look at is how much more gap do you have between what your living expenses are and the next tax bracket, right? And say, all right, well, could I potentially put away some of it into a Roth IRA and let it grow for a few years, right, where I wouldn't need to touch it, And so all of that grows ends up being tax-free. And so again, you will have additional taxes during that year if you find that manageable. But it's going to be a little bit more of an in-depth conversation with you saying, okay, well, what do your expenses look like? What does your income look like? Where's the gap? And how do we bridge that gap, right? Does that make sense?
Sounds more like maybe more beneficial to maybe a couple of years, smaller, keep your tax bracket under, like that Roth IRA,
Mhm.
and then start feeding off of it.
Yeah. So yeah, again, if you can kind of save just a little bit for a few different years and maybe invest that aggressively, right? Hopefully grow, maybe put 5,000, 5,000, 5,000, right? For 3 or 4 years, right? Now you have $20,000 that's been growing for 4 years, maybe 5, but at least now you have a bucket, right? This is more for emergency expenses, right? So my biggest concern is I would rather you pay a little bit more now in income taxes than to be, have some sort of medical emergency or, need to remodel your house or whatever it is. And now the only bucket that you have to pull from during that time when it's a large chunk of expense is that one, right? So again, just giving a little bit of flexibility is a really, or having some flexibility is really important, and hopefully will allow you to breathe easier, which is pretty much our job, right? Is making sure that you're comfortable. Does anybody have questions on that, or does that make sense? Okay. Does anybody else have questions on anything? Yeah, sure.
Talk a little bit about 80% and the 20% rollover.
Yep.
How the timing of that. I didn't quite get it. I'm sorry. Can you
Sure.
go over that in a little bit more detail?
Sure. Yeah. So the question was about the indirect rollover, right? So essentially, with an indirect rollover, what the person essentially they're going to cut you a check, right? So an indirect rollover, you tell the 401k company or the IRA that you're with, hey, I want my money, right? By law, they have to withhold 20% for taxes, right? In the event that maybe you run away and you don't pay taxes, right? Just bail out and go to Mexico. But so essentially, they're going to withhold 20% in taxes by law, and so let's just now you have 60 days to reinvest that other 80%, right? In order for it to not be to count as a distribution, right? And it'll just be a rollover at that point, right? So now, once your 80%'s over there, you now have to fund the additional 20% within that 60 days into that account, or else that 20% that they withheld is going to look like income for you. Does that make sense? Okay. Yep. Yeah, so the CPA will help you tie that out and make sure it shows up as a rollover, to the penny, right? And so they'll classify it like that. And essentially, what you're going to do is you're going to get that money back in a tax return, right? Usually, because it's already withheld. Does that make sense? Okay. Any other questions on what was that?
We do have a question from the webinar.
Sure.
So it's I left a job that offered a 401k.
Mhm.
Not sure if the best way to roll over tax implications. What are the tax implications if I rolled over to a Roth IRA?
Yeah, so good question. So the tax implications of rolling into a Roth IRA are just that, right? Anything that you roll out of a regular 401k into an IRA, into a Roth IRA, is going to look like income for whatever year you did that, right? So if you roll over your entire balance from a 401k to a Roth IRA, the government's going to look at that as income for that year, right? So you want to be really careful when you're doing large transfers over, things like that. You need to be pretty delicate with it. So if it's a large sum of money, I would recommend against, or at least talking to somebody about it and see if it's the best option for you, because likely there's probably going to be a better option. Yeah.
Question on, because of the age of everybody in the audience,
Sure.
we've all seen interest rates go from about 14%
Yeah.
down to about 2%.
Yep.
Consequently, I think a lot of folks here have gone into common stocks.
Yep.
That pay a decent dividend.
Yep.
What's the prognosis for the next 20 years?
Yeah, great question. So the question was around around interest rates and I guess a little bit of a stock market outlook, right? So essentially what's happened recently, especially after 08, we went through some QE, quantitative easing, right? So the government said, what we're going to do is we're going to make it a lot easier for the people of the US to lend, to borrow, and to buy stuff, right? And so that's where they started to drop the interest rates, right? The Fed has a mandate, the Fed being the Federal Reserve of the United States, they control the interest rates, right? Now they have a mandate to do two things essentially, right? One of them is to keep everybody employed, right? So to reduce unemployment, and the other one is to make sure that inflation doesn't get out of hand, right? So when you saw those 14% interest rates back in the day, that was after a really big bout of inflation, right? And so a brutal, yeah, exactly. And so they had desperate times called for desperate measures, right? And so what we've seen since then, obviously in 08, is we've seen a very low interest rate environment, right? Artificially low interest rate environment. I remember my grandpa bragging about a 5% mortgage that he got, before the boom, right? And then now mortgages are about that, if not less, right? Which is great for the consumer, right? Now what we've seen, the borrower, great for the borrower, not so much for us, so fixed income, right? CD rates, bond rates, things like that, the traditional ways that people in retirement would get safe income really aren't there anymore. And so we're forced as advisors as well to look at alternative ways to do that. It may be preferred stock, it may be a closed-end fund, it may be annuities, it may be market-linked notes, it may be, there's a lot of different options that we have, but like you said, a lot of it's going into the equity space, right? That's really where money's being made right now, is in the stock market, right? Because there's really no return elsewhere as well. So what I see is that we've actually had the reason why Jerome Powell last year, or in 2018, decided to that he might raise interest rates 3 times in a row, is because what he saw was the unemployment rate dropping, right? We have an unemployment rate that's actually below our job openings right now, which is the first time we've ever seen that, right? But what we haven't really seen is wages ticking up, right? So what he was reading was what's called the Phillips curve, right? The economists call it the Phillips curve, which is, hey, as jobs go down, prices go up, right? So because when you have unemployment going down, you have less job openings, so people need to be compensated higher for those job openings, right? So the wages go up, and then more wages spur more spending spurs more inflation, right? So he tried to stamp it out ahead of time. What we haven't really seen that 2% inflation yet, right? So that's their key target. Not only that, the Fed has also said we're going to keep it lower for longer, and we're going to wait till that inflation goes up above that 3% line. So bottom line is, I think that we're going to probably be in a lower for longer environment, right? I think until we start to see global recovery come around a lot more, we're going to be forced to keep our interest rates lower, because if we start to increase our interest rates, then our bonds are going to pay a lot more than, let's just say, these different countries with negative interest rates right now, right? Japan, Germany, right, have negative interest rates, for instance, right? So that means more money is going to flood over to the US, right? So if we have a bond that's being issued at 2% versus a negative interest rate, where do you think they're going to go? The safety of the US with a 2% interest rate, right? That's going to make our dollar stronger, and that's going to make exports a lot more expensive. So other countries are going to be less likely to buy our stuff, and our GDP might go down, right? So we're going to be forced to probably stay in this lower interest rate environment for longer, meaning that I think that we still have a little bit more time where I think, over the next few years, the stock market really is going to be the place to be. And so being more comfortable in the stock market and being more comfortable with fluctuations in your portfolio, or learning to become more comfortable, right? And learning what you're in and knowing how you're invested, and being comfortable with that is going to be really key, because I think exposure to the stock market will be one of the true ways to get meaningful value out of your portfolio over the next 5 to 10 years, right? At a certain point, we will see it tick back up. I agree, but fixed income is going to be a tough place. It's going to be more of a way to have small amounts of earnings and have dry powder on the side, right? So does that answer your question? Okay, perfect. Does anybody have questions on that? Did any of that not make sense? I know there's stuff that didn't make sense. Okay, all right, good. Did that make sense? Did you catch all that? Have you started saving? Has she started saving at all? Oh, sorry. Sorry. Hey, cool. Nice. Hockey's awesome. Have you started his NHL money? Well, there you go. Salary, man. You gotta. That's a good market to be in, the professional athlete market. That's awesome. So, does anybody have any more questions about anything? Yeah. So to close up, I guess there's a lot of different rules associated with distributions. There's a lot of different ways to invest your money, to save for retirement, and to spend. And our job is to essentially help you make the most amount of money and keep the most amount away from Uncle Sam that we can legally. But again, if you guys have any questions, or if you ever want to set up an appointment with us, feel free to come up. I'm here for questions afterwards too. Oh yeah, if you fill out the evaluation, that'd be great. I would really appreciate that. There's going to be a raffle again, so there's going to be a $25 gift certificate mailed to you. So whoever wins that